Investor Brand Network, IBN, a multifaceted communications organization engaged in connecting public companies to the investment community, is pleased to announce the launch of the Stock2Me podcast as part of its sustained audio communications effort to provide specialized content distribution via widespread syndication channels. The following Stock2Me podcast is an Investor Brand Network audio production and may feature a client partner of IBN. Investor Brand Network may have been compensated for the production of this podcast. Please be sure to read our entire disclaimer for full disclosure. Thank you, and here today is your host of the Stock2Me podcast.
Welcome back, everybody, for another online business briefing. We appreciate you making us part of your day as well as part of your due diligence. Today, we're speaking with Rod Turner. He's the CEO and founder of Manhattan Street Capital. They are the #1 growth capital service for mid-size companies. Rod, welcome to the show. Thanks so much for making time for us.
Hey, Stuart, thanks for having me, and thanks to the audience for listening.
Absolutely. We look forward to learning so much more about your company. Now, listeners, you can do so as well by getting social with the company, manhattanstreetcapital.com. You can go to LinkedIn, you can go to Facebook, but I'm going to also point to you YouTube. Rod has done a terrific job with some videos that have come out throughout the year. I want you to go look for Manhattan Street Capital on YouTube. But before we learn more about who your company is, Rod, you're our guest today. We'd like to learn a little bit about you.
Sure. Thank you, Stuart. So I grew up in England. My first career was as an professional electrical engineer on a nuclear electricity generating station. And then I moved into computers in England, mini computers. And then I moved to the States for better weather and better opportunity in that same business. And then I was fortunate to meet a guy that had joined a startup company and had tremendous success in his career as a result. So I looked around and found a great company called Ashton Tate, which I became the 12th employee of. And this was very early in the life of the microcomputer business. We built DBase. It was DBase 2 and then DBase 3 and 3 Plus became the market leading database on microcomputers a long time ago. We took the company public. I was a VP of international business when we went public. And this was just a phenomenal journey. I had run sales and marketing and actually a large part of the business in the early days because I was the only guy that would show up and take whatever the founders would throw at me. It was a blast. And then I went on to help to build 6 other successful startup companies prior to Manhattan Street Capital. One of those is Symantec, the Norton antivirus company. I was there from the get-go and ran sales and marketing and international and product management. And then when we started growing by buying companies, I took over the acquisitions or really I should say the implementation of the combinations of those companies. The most notorious or the best known of those was when we acquired Peter Norton Computing. And I became the general manager of that business and combined it into Symantec. And over the following years, that became Symantec. And that is to say, its growth rate, that division of the company grew so fast that the other parts of the company sort of became less significant. So that was phenomenal. That was the second NASDAQ IPO that I have had the privilege to be one of the top executives for and with. So that was great. And subsequent to that, I've done a number of other startup companies in high tech with liquid outcomes for all concerned. Venture fund called Irvine Ventures in Orange County, and an incubator that my partner Safi Qureshi and I had set up at the same time. And that's sort of essentially me morphing from an engineer into a leader, a CEO, an entrepreneur, a founder of successful companies. And obviously I've both made mistakes and observed others and had success and observed others and learned a lot along the way.
Well, you're in my old stomping ground. I was born and raised in San Diego in Southern California, so I'm excited to speak with you today and learn more about why did you decide to start Manhattan Street Capital, but you really gave us that. I mean, it was a natural journey for yourself from engineer to this point, but let's talk specifically about how you did and why you started Manhattan Street Capital.
Sure. So there was already a thing called Reg A, which has become outmoded over time. But I heard of this thing, Regulation A+, And I knew there was changes in the offing because of the thing called the Jobs Act that was passed in 2012. But in 2015, in March of that year, Reg A Plus was announced, and it went effective late June of 2015. When I read the regulation, I was so impressed that a gigantic entity in the SEC, the regulator for stock transactions, equity transactions in the US, I was shocked and impressed with how well written Regulation A Plus is. So, having raised money and invested money in startup companies over so many years and such a large portion of my business life, I'm aware of how the current then climate for capital raising was limiting lots of great companies that could otherwise justify and deploy growth capital successfully and make public offerings successfully that weren't able to. And Reg A Plus provided a phenomenally great way to up the ante to improve the situation. So, given my background and the fact that I was looking to do something interesting, the timing was great. So I decided to do Manhattan Street Capital to start the business. We went live in May of 2015, about a month before Reg A Plus became effective. So we were the first Reg A Plus focused offering platform in what is essentially crowd investing, right? In people online investing in companies they like. So, I believe that, Reg A Plus will, when it hits stride, be a very, very large segment of the capital raising industry or for market, if you will. Whereas we've grown from zero in the summer of 2015, initially quite slowly as a category. I say we, when I say we, as of now, probably about $5 or $6 billion a year is being raised in Reg A Plus offerings across the country, which is, when you look at private placements as a category, they're approximately $1 billion a year. So we see Reg A Plus has significantly eclipsed the private placement space. And, IPOs typically will be about $160, $200 billion a year of capital raised. So there's a very large amount of headroom through into which Reg A Plus can grow, but it's now become accepted. I think largely because of COVID, people getting stuck at home. That's increased the acceptance of online investing overall. So why I launched it? Great opportunity, great need, and it suits my skill set and experience.
Well, you talked about some of the drivers of the Reg A Plus and Reg A market to date, one of those being COVID. What significant trends do you see in the online capital formation business going forward into 2023?
So there's a number of factors, right? The state of the market being very difficult. The fact that Apple is making it more difficult to market products of any and financial offerings on mobile devices, or Apple mobile devices, is another factor. And the maturity, or I should say the acceptance of crowd investing online. It's become credible, so institutions participating in it. And the longer we're doing this as an industry, and obviously my company and our customers, our client customers that we help, the longer we're doing this, the increased ambient awareness there is among CEOs and CFOs when to use an online offering, particularly Reg A Plus, when to use Reg A Plus to conduct a public offering, and when to raise money via this method, and which companies are best suited to it. So there's some new aspects to that. To my mind, one of the biggest ones, given how terrible the financial market dynamics are today, is that we often hear about how the IPO window is closed, right? Well, there are some people that misunderstand what that means, understandably. It doesn't mean that the SEC, the financial regulator, will refuse filings from companies that want to make a public offering. It doesn't mean that. They'll always accept the filings. It's up to the company itself and its broker-dealers and other partners to make their offering successful. But the SEC isn't going to say, oh, no, the market's tough, you shouldn't do this. What really happens is that in conventional IPOs, the underwriters say no. They won't take on 99% of the companies that want to do an IPO in a market like this because it's too expensive for them. It's too risky. It's too difficult to succeed. So what's interesting to me here is that there's been this gradually evolving method of conducting public offerings called direct listings, a direct public offering versus a S1 IPO or a conventional Reg A plus IPO, which you can do, where once you have raised enough money from enough investors in the correct manner, and when you have a proper filing, which could be a Reg A plus or a Form 10 or an S1 IPO, filing with the SEC, depending on the circumstances. If you've got enough investors and you have enough money in the bank and your company is otherwise completely legitimate and passes muster with NASDAQ or the NYSE, you can do a direct listing of your company. And that one, you don't have to go and ask permission of an underwriter. You don't need to use an underwriter. Now, most direct listings have used underwriters, but it's been on my radar for some years now to help our client companies make a public offering via direct listing because it's so much less expensive, and you don't get the door closed in your face for 4, 5, 6 years, which can easily happen in a conventional IPO format. So there's one company that's done this in September of this year, in a very, very difficult market, actually the end of September, beginning of October. They did a direct listing and it worked fine. They had raised enough money from enough investors and conducted their public listing, and they're on the NASDAQ now. That's something where I was able to provide some background assistance to them, I'm pleased to say. But, the point is that the IPO window isn't actually closed anymore, right, in a difficult market. Now, of course, you don't want to casually undertake a public listing of any kind, and especially on the NASDAQ or the NYSE. But the ability to do so in difficult markets when you have a vibrant company and a good package to bring to market is super. So another area is that we've all been gradually becoming more aware of climate change and how devastating it can be and is economically and on humankind and on other kinds of living beings. But what's happened now is that in the US, I believe, because of regulatory change, new legislation, and just the passage of time, it's become clear that there are significant financial opportunities in doing things to reverse climate change. And that's something I believe is very, very important for us as humankind. And it's great that there's a recognition that there's a need and an opportunity to make a lot of money doing what's needed to be done in reversing climate change. So I see that as a tremendous investment opportunity, as well as opportunity for new companies and for companies that already exist to adapt and take advantage of what is a serious need and a serious opportunity. Other significant trends, I mentioned earlier that Reg A Plus has become accepted and credible. So we're seeing institutional investors participating in Reg A Pluses that they would never have looked at in the past. We're seeing very rapid growth in this category. So we're helping more companies as an industry than we ever did before. And we're seeing much higher quality companies that are more established with more customers, more online presence, more market awareness get involved. The quality of the companies that we're helping to conduct successful Reg A Pluses is so much higher now than it was 2 years ago, 5 years ago, 7.5 years ago when we launched Manhattan Street Capital. So that's that acceptance and the quality level. You can do secondary offerings via Reg A Plus for existing public companies. And it's very cost effective and very flexible and suits some companies to a T. Nobody was thinking about that, or at least the only ones who were thinking about it were lesser known companies that were already having a difficult time. Now we're seeing higher quality companies availing themselves of the opportunity to use Reg A Plus. And then another development that I think is hugely significant in this space is that the SEC has allowed these things called ATSs, alternative trading systems, as a category, and they're a new kind of stock exchange as a category. It's much less expensive for companies to create them, and now there are probably 30 or so that exist. Probably, I would say there's too many of them. There'll be a consolidation in that space. But the point is this, that if a company conducts a Reg A Plus, which is a public offering by definition, anyone can invest in it. We'll get into that in a moment. But anyone can invest in Reg A Plus, which is great. And it is a public offering. Then the question is, do you list your company? And if so, where? If you list your company on the OTCQB or the QX or on the NASDAQ or the NYSE, they progressively have marvelous upsides to them. But they also have the downside that stockbrokers can very easily put naked shorts on relatively illiquid, newly listed companies and devastate their share price. It happens all the time. This is a horrible dynamic. If you list your company on an ATS, guess what? They don't have shorts, and they don't have naked shorts either. So it's a simpler place to list your company, provide investor liquidity. You're not going to see the obscenely high valuations that you can see when, in lovely times on the NASDAQ or the NYSE, but you're also not going to have your stock price decimated by unscrupulous broker dealers, stockbrokers shorting your stock when there's no borrow, and they don't have to have borrow, and they put naked shorts on. So it says to me the inherent reporting obligations that you get with conducting a Reg A plus are so much less demanding than if you list on the major exchanges. You have a once a year US GAAP audit and 6 monthly management financials, and obviously reporting any material events in the company. That's so much less onerous of itself. But the fact that you don't have to spend so much management time being paranoid and doing everything reasonable and legitimate to promote your company in proper means and arm your company to prevent or reduce the attractiveness for stockbrokers of putting a naked short on. So companies that are smaller but exciting can conduct a public offering via Reg A Plus and list in a less damaging, less risky environment, which I think is super.
Yeah, you've given us some excellent points on why Reg A Plus are better than the old ways of going public. And you also gave us some astute observations on that IPO window, whether it's closed, open, halfway open, but just the nuances there. So what I'd like to ask you next is, what type of businesses are you excited about helping to raise capital in this current market climate, which you did point out early? I mean, it's choppy waters for sure.
Yes. So I'm going to give you a disclaimer here, which matters intensely. So because Manhattan Street Capital helps companies raise money online, because we've chosen not to be a broker dealer, we are not allowed to solicit. I'm not allowed to say, hey, let me tell you about this company. It's great. You should go look at it. So I'm not going to do that. I'm going to talk about companies that we are involved with or aware of, but I'm not going to name them, except in the circumstance where we're no longer helping them, in which case I can talk about them. Mm-hmm. But so, if I mention a company name in the following bits here, then, just recognize that there's a conflict of interest because we have stock in them, or we have a relationship with them of some kind, but we're not raising money with them or helping them raise money right now. Otherwise, if we were, I wouldn't name them in any case.
I can appreciate that. Thank you.
Yeah, you're welcome. Thank you. So in the reversing climate change areas, I'm seeing some amazing companies doing really great things. So solar combined with geothermal as a way to convert residences and golf courses and office buildings and hotels can and is a phenomenal opportunity. When you think about the percentage of such buildings and car parks, think about the percentage of those where they could leverage solar, and if they include geothermal and electricity storage, they can become independent of the grid, save a lot of money, and clean the environment, reverse climate change. That's a huge opportunity area, which is timely, right? So phenomenal opportunities for companies in that space. Recycling concrete, concrete is, I think, production of concrete is the number 3 source of greenhouse gases on planet Earth. Making concrete recyclable, I know a company that has done so, where you can recycle the concrete on site and build a new building using the concrete from the buildings you tore down, because they replace the steel rebar, which it makes it very difficult to recycle the concrete, with a replacement for steel rebar that enables you to recycle the concrete. That's phenomenally good commercially in reducing wasted concrete and wasted time, and also in reducing greenhouse gas pollution. And the fact that their steel rebar replacement does not rust means you can build buildings that'll stay standing, bridges that'll stay standing without falling down, because the steel rebar and the concrete rusts away over time. And that's why you see buildings and falling in the water like we saw earlier in the year in Florida. So huge opportunity. Steel rebar alone is $200 billion a year plus in revenues. They're just making and selling steel rebar. So you can see there's a giant opportunity for companies that are addressing that. Another company that I know we've invested in this company through Manhattan Street Fund. They have reinvented the electric motor. And the first time I heard that, I didn't really believe it, although the company came to my attention through a very credible source. So I wanted to believe it. Then, when under non-disclosure, I was briefed as to how they've done it. They have actually reinvented the electric motor with the result that you don't need a gearbox. So you save all the weight and expense and reliability issues that go with having a gearbox. You get full torque at any RPM. And this motor is twice as efficient in its use of weight. The mass efficiency is doubled and the volumetric efficiency is quadrupled. So you can make a motor that makes the same power as the current state of the art in 1/4 of the space. And it has amazing applications beyond what you would consider possible with today's motors. So if you imagine when you walk into a commercial jetliner, when they let you walk across the concrete or the asphalt to go up steps into the plane, you see the cowling for the jet engines. Imagine an electric motor which is installed around the perimeter of the fan, and it's not anymore a jet engine, it's a fan propelling the airplane in flight. Right. Imagine the components of the motor on the tips of the fan blades and in the perimeter around the periphery of the cowling. To do that with an electric motor is pretty cool, right? So huge opportunities to reverse climate change, to enable different applications for motors than are currently available, and what a great investment opportunity too, right? I haven't named it, so I'm okay. And then another company that has developed a method as a side effect of something else they were doing. They figured out how to smelt steel in a completely green manner, right? So steel production is the fifth largest producer of greenhouse gases on planet Earth. They can make steel completely green. And the most important part of this manufacturing process costs less than the current method. This is seriously big stuff, right? Talk about commercial opportunity, doing good, reversing climate change, and building a tremendous success along the journey. Another company that I've been in discussions with in more recent time, they have figured out a way. You hear about fuel cells. Electric cars are obviously huge these days. Fuel cell propulsion, Toyota's been pushing that, and other companies want to. The problem is that the fuel cell has to be at immense pressure to store the hydrogen in order to propel a car currently. Fuel cells with hydrogen fuel storage is dangerous and expensive, cumbersome. There's a company I've been in discussions with that has figured out how to produce hydrogen on demand for an internal combustion engine that's completely clean, and the exhaust byproduct is water vapor. So what they do is they store a mixture of water and their proprietary electrolytes in a tank that's like a fuel tank, like a gas tank in a car or a truck. And then as they need it, they convert it on the fly into hydrogen that is then used for combustion purposes in the engine. The engine gets adapted for this use of fuel. And they've demonstrated this already as being a viable way to propel a car or a truck or any other vehicle using which would be currently using a traditional internal combustion engine. So you've got green components, green ingredients, and a zero pollution exhaust. And their estimate is that it's going to cost 50 cents a gallon of fuel. Mm-hmm. So lower cost of fuel. Phenomenal, right? The only downside of that company is it goes against the current excitement around electric cars with batteries, But this will enable companies to adapt their current cars and trucks and buses in an easier manner where they don't have to throw away the whole fleet and start from scratch. And obviously in new car production, I believe there'll be companies making cars and trucks using this technology over time. Super. And then another area that I see great opportunity partly because of the state of the financial markets, is in roll-ups. Companies that are growing by acquisition. You can buy marvelous companies at a discount in this kind of environment. So we'll be seeing a lot of Reg A plus offerings and other offerings for companies that are growing by acquisition. Then in biotech, CRISPR, with which you can edit human DNA. It's phenomenal and exciting. They're starting at the top of the list with the biggest afflictions of humankind and reprogramming the DNA, editing human beings' DNA. So the sort of thing they'll be able to do, I look forward to helping these kinds of companies editing, if a woman has a predisposition to risk of getting breast cancer, their predisposition can be programmed out by editing their DNA. So it's just a matter of time before that becomes commercially available after getting tested, of course. And other kinds of afflictions, whether it's autism or Alzheimer's. In my view, wherever a genetic predisposition causes a human being's health to fail or death or other debilitating malaise, when it's a DNA centric thing, then CRISPR as a broad technology editing DNA, they're gradually moving down the list and doing tests on more and more things. So we're going to see an awful lot of marvelous progress there. And biotech has already shown itself to be suited to offerings in Reg A Plus, where we're marketing online to consumer investors. If they like what's being done, if they can understand it, then biotech's a marvelous category where Reg A Plus suits it beautifully. I mean, there's a company, they've completed their first Reg A Plus. They have developed artificial intelligence modeling of humankind and full DNA analysis. So both chains of human DNA getting analyzed to figure out what propensity to what disease a given person has and which drugs will help them. System enables them. Their modeling system, and my company owns stock in their company, so I have a definite conflict of interest here. But I am a true believer in this company because they're doing marvelous things. They're able to bring new medicines forward for clinical trials much, much more rapidly because of their human modeling system and their sophisticated DNA understanding. And therefore, reduce the cost and increase the rate at which they bring new medicines to market. So they're going to save a lot of lives, in my opinion. And it's just emblematic of what AI and understanding the human DNA offers in the way of tremendous upside opportunity. Of course, there are other companies, or are going to be other companies in that space. So this isn't a one company category, but the application of artificial intelligence and machine learning in combination with thorough understanding of human DNA. And in the past, the people with this DNA, what did they experience? Which drug were they treated with? How did that drug outcome work out? Was it a good thing or a bad thing? And being able to guide doctors to give a cancer patient the right medicine from the get-go instead of on, test number 6, where they may be dead or alive at that point. Phenomenal. So other more sort of functional areas where I see great opportunity, we've seen the emergence with TikTok and Facebook and Instagram and other social media of influencers, people who are very powerful because of their followings. Those people can conduct online offerings where they've already got a giant audience. It's a no-brainer, pardon the term, for them to use Reg A Plus and other online fundraising methods to raise capital, to expand their business empire, to perhaps sell ownership in their business or sell ownership in their future income stream. Influencers, because they already have a following, the cost of conducting a Reg A Plus can be so low for them. The marketing expense being the most expensive part. When they already have such an audience, it's a marvelous thing. Series offerings are a thing of beauty in Reg A Plus, where you can, for example, one company did a Reg A Plus for racing horses, where you could, within an LLC, investors can buy interest in a particular horse that they love. That kind of thing. Again, the fame of the horse in that case. You can imagine doing it for baseball teams, for football teams, for very famous musicians and famous actors. They can leverage their fame to both make their financial situation better and give people in their audience that love them and want to be a part of the journey an opportunity to buy in. Those are good things. And another example is water as a service. There are so many parts of the world, and even the US, where people don't have access to clean drinking water, safe drinking water. I'm aware of a company that has developed a water as a service business model where it makes it so much less expensive to provide clean water, because the company or the entity or the city or the town or the RV resort or the mobile community resort, or vacation resort, they aren't paying for the kit. They're not spending the capital up front. they are renting, if you will, water as a service, paying for it as they use it. So there's so many places around the globe where there is no water at all to be had or insufficient, and other places where the water is available but it's dirty and needs to be cleaned up thoroughly. Marvelous opportunity commercially to do something really worthwhile. There's so many other things, but hopefully you got a sense of it from that discussion.
Yeah, outstanding. Rod, this has been a wonderful interview, and I hope we get the chance to speak with you early and often in 2023. Your insights are invaluable. Listeners, once again, we're speaking with Rod Turner, CEO and founder of Manhattan Street Capital. Go out there and socialize with this company, link up with them on Facebook, Twitter. Make sure to go out to YouTube as well and see some of Rod's fabulous videos that he's posted there as well. Rod, thanks so much for your time here today. We hope we made it painless, and we hope we get a chance to speak with you in the new year.
Sounds good to me, Stuart. Thank you very much for having me, and thanks again to the audience. I hope that this has been helpful to you and informative. Have a great day.
All right, for Rod Turner, this is Stuart Smith saying thanks so much for tuning in.
The following Stock2Me podcast was an Investor Brand Network audio production. IBN is a financial news and publishing company delivering a new generation of corporate communication solutions, including news aggregation and syndication, social communication, and enhanced news release services. Investor Brand Network may receive payments for corporate communications relations, as well as various press releases and social media solutions provided to its clients. IBN holds no shares of any company named on the IBN sites, brands, and/or podcasts. To be clear, all officers, directors, and independent contractors of Investor Brand Network hold zero positions in and do not trade or intend to trade the securities for their own accounts. This interview is not an offer or recommendation to buy or sell securities. Information in this broadcast is presented solely for informative purposes and is not intended to be or should it be construed as investment advice. As in all investments, investment in the featured company carries an investment risk. Listeners should review the company thoroughly with the registered investment advisor or registered stockbroker. This podcast audio interview by Investor Brand Network is not intended to be a complete study of the featured company or other companies mentioned. Information used and statements of fact have been obtained from featured company and other sources, but not verified nor guaranteed by Investor Brand Network as to completeness and accuracy. Such information is subject to change without notice. Please see our full disclaimers and disclosures at investorbrandnetwork.com.